Okay, recording now. So we're on page 81 of your course pack, and I was showing you how the balance sheet looks. Your course pack total is slightly different because we don't have the comprehensive, but it has the elements here. So we said 400,000 is preferred stock, 10,000 shares issued, 4,000 shares issued. So 4,000 times the par of 100 is 400,000. That's your balance in the preferred stock account. And I had you put T accounts across the top or bottom of this page. So preferred stock has a credit balance of 400,000. Common stock has a credit balance of 900,000. And that's the issued amount, not the outstanding, but the issued amount times par value. So that's 900,000. Now it's telling us we have 285,000 shares outstanding, and that tells us that the company has treasury stock. And down here, you can see treasury stock, 15,000 shares. And that means we issued 300,000, we bought back 15,000, leaving us with 285 outstanding, still held by the stockholders, not by the company. Okay. Any questions on that? Okay. Additional paid in capital is just the dollar amount difference. And then you add these two together and you get the total value of the paid in capital. And then on Wednesday, I said to you, what was the average selling price of the common stock? Okay. And so what you would say is add the 900,000, the balance in the T account common stock, and the 380,000, the balance in additional paid in capital, common stock, and then divide it by the issued shares, and you get your issue price, your average selling price on the market. Okay. Any questions on that?
Real quick, what page is this again?
Page 81 in your course pack. Okay, we worked on this a little bit on, let me put it in the chat. Page 81 in the course pack. Okay. All right. So our numbers are close to what is here, but the total, what you guys give for the total? We got 2, 3, 8, 7. We got a little bit. What's your bottom line on page 81? Total stockholders' equity. Put it in the chat or call it out, please.
I got 2,337,000.
Has everybody got that number? Yeah. And I've asked you not to include this 82,000. We're not going to talk about comprehensive income for this class. It's an advanced accounting concept. So we're not including the 82. So, okay. So 7. All right. All right. So I just wanted to show you, we've looked at this before, but now we're adding treasury stock. So paid in capital is common stock. And then we have this really long, kind of ugly name for the additional paid in capital. But remember, I put APIC common stock or APIC preferred stock, and you can use those T account titles as well. You don't need to put these great big titles here. Just APIC CS or APIC PS is just fine. Okay, that's all your paid in capital. Your earned capital is retained earnings, and after your paid in capital and your earned capital, that's when we subtract treasury stock. And so that's what we did here, less the treasury stock, okay, at the bottom. Treasury stock journal entry is so simple. So I'm gonna jump ahead and show you the journal entry. On February 1st, Geo Company acquires 4,000 shares of its treasury stock at $7 a share. And we don't care about par value for treasury stock. We just book it at the cost that the company paid for it, okay? So they just say debit treasury stock, credit cash. And because the T account treasury stock, it's part of stockholders' equity. It's one of the stockholders' equity accounts, but it's a contra stockholders' equity. So it has the opposite balance of stockholders' equity. Contra stockholders' equity. And again, okay to abbreviate treasury stock when you're doing journal entries as T stock. I can understand that. All right. So we book treasury stock at cost. If you go on into advanced accounting, you'll learn that you can also book it at par value, but most companies prefer just the cost method. So we paid, at the time the company reacquired treasury stock, they paid $7 a share. Okay. All right. Okay. So why do companies buy treasury stock? Why? Okay. So this is a little bit weird, but if you work for a company, and you're a high up executive, sometimes they pay their executives, they reward them as a bonus. They'll give the executives, the top managers, treasury stock. We're giving you a bonus of $5,000 in company stock. Okay. Again, that's a device to kind of keep the top managers, who, remember, are usually professionals and not necessarily the owners or the founders of the company. So we're trying to keep the top management more connected, what I like to call more skin in the game, that they own part of the company, so they have even a more interest in making the company profitable. All right. So that's reason one. Stock compensation plan, sometimes that's for actually paying you. Your payment is $100,000 a year. You'll get $70,000 cash and the rest in stock, valued at $30,000. Okay, again, trying to keep the managers very interested in making that company successful. Okay, so next, to enhance the stock market's value. And so less stock on the market, they're hoping to create some sort of demand, supply and demand that you hear about in economics. If a company is acquiring another company, when Pepsi Cola bought Frito-Lay, they had to, actually Pepsi owned for a while, they owned Jack in the Box, Kentucky Fried Chicken, and Pizza Hut. And so when they acquired those companies had their own stock, but then that stock was bought by the acquiring company, and they had to have enough stock to buy out all the stockholders and give them Pepsi stock and retire the Taco Bell and all those stocks. Okay. So lots of mergers and acquisitions in the 80s and 90s, not so many now, but you still see them. If we have less, so this will increase earnings per share. Remember, earnings per share is net income divided by outstanding shares of common stock. So if you have less shares outstanding, that'll raise the earnings per share value. And then to buy off bad investors and just say, we'll buy back your stock. We'll just get you out. We don't want you voting. We don't want you participating in the company. Okay. So they buy it back. We debit treasury stock for the price paid to reacquire, contra equity, and it reduces stockholders' equity. Okay, and that's the journal entry we saw. So up here is the before picture. Geo Company has common stock, has retained earnings, has total stockholders' equity of $600,000. After they buy back, after that journal entry, they reduce the stockholders' equity by $28,000, and you have new stockholders' equity of $572. Okay, and now they no longer have 100,000 shares issued and outstanding. Let's go back one. Up here, they had 100,000 shares issued and outstanding because they had no treasury stock. After this journal entry, they still have 400,000 here, but they're disclosing that they have 100,000 shares issued and only 96,000 outstanding because they bought back the treasury stock. So what's interesting to me is that the common stock account does not change when you purchase the treasury stock. It stays at the original value, the issued value. But we have this other account, treasury stock, that shows how much they bought back. So it's a little bit like going back to the equipment account minus the accumulated depreciation. We hold that common stock account at the original issued amount. All right. So we talked about this on, what did I do here? Let's do home. Okay. All right. So if you have total authorized shares of 1 million, okay, if you've issued 400,000, the treasury that you've bought back, the company has bought back, is part of that 400,000. So that becomes the treasury stock, and the outstanding is 385. But the issued amount still stays at 400,000. Okay. And this is just unissued shares. There's no value to the unissued shares, but they're available in case the company wants to issue more shares. Okay. They have no value. All right. All right. Okay, let's go to the practice exam, not my email. And let's bring that up. So do you guys have specific areas you want to go over for the practice exam?
Yes, I do.
All right, great. Would you be willing to share your areas with the class?
Yes, but I have it on paper, so should I turn on my camera?
Sure, you can, hang on, let me, yeah, turn on your camera and maybe hold it up. Let's see. Let me just make sure I have the right exam up. Okay, all right. I'm going to stop sharing. I'm going to go ahead, Peter. Okay, which question do you have? You're on mute.
Oh, the second question.
Okay.
See that? It was about the bond amortization.
Mhm.
My question is that on here, right? It was talking about the effective interest, right?
Correct.
I was thinking the effective interest was the market interest, right?
Correct.
But on the paper it says it's the premium amortization. So I got confused, right?
Okay. All right. So what did you put? Let's see if I can bring up, you know what? I want to bring up another file. Let's see. I want to bring up. All right, hang on. Got this. All right, here we go. That's better. All right, then I can fill it in. Okay. So let's talk about language here so we can make sure. Is this the Hawk company? I think it is. Yeah.
Yeah.
All right. All right. So we have, so did you get your first journal entry up there? Oh, let's go here. Okay. Hawk company issues $300,000. Wait a minute, let me share my screen. Okay. And if you guys have other questions, put them in the chat that you want to make specifically that you want to go over. So, all right. So Hawk company issues 300,000 of 8% 4-year bonds at 10339, yielding an effective interest rate. So when you see the words effective interest rate in your mind, think market. Okay. The market interest rate of 7%. Interest is paid January 1. Okay. So what did they get for the bond? Did you get that much, Peter, yesterday?
Oh, wasn't it? They sold it for 310,000. They sold it on there. Can you hear me?
Yes. Say it again.
So they sold the bond for 310,170.
No, you did. How'd you get that number? So
I multiplied 300,000 by 100 and by 1.0339.
okay. So you got that?
Yeah.
And then if you guys get this much, I'd be so happy, but let's, what do we always put for bond payable? What do we know is going to be the value in bond payable?
Par value?
Yes. So what's par value for the bond?
300,000.
Correct. All right. So do we have a discount or do we have a premium? Do we have a debit or do we have a credit?
Credit.
Yeah. So we got to balance this thing. We got 310 on the debit side, 300 on the credit side. How do we balance it?
Credit.
Good. Okay. So it's going to be the difference, right? If it's a credit, what does that mean? Is it a discount or premium? If it's a
Premium.
good. So it's going to be premium. Oops, that isn't a premium. And if you guys use this kind of abbreviation for the test, I am totally fine with that. So don't, you know, BP, I understand that. If you put BP here, I understand. Just make sure I can read your handwriting. Okay. Okay, so now it's saying accrue the first interest accrual, and you have to fill out the amortization table before you can do this. Okay. So what I like to do is say bond carrying value. So I like to put the bond face value up here for reference. You can do the same. You don't have to, but I like to put the face value up there. Okay. So bond carrying value is going to be whatever cash we got for the bond. So that's going to be what?
Oh, 310,170.
Good. Okay. All right. And what's the unamortized premium?
10,170.
Great. Okay. So we essentially have, so this 310 is equal to, now remember the bond payable account, if you think of these as T accounts, see if we can do this. If this is the bond payable account, it's currently got a $300,000 balance in it. Okay. The premium on bond payable has a 10,170 balance in it. Okay. This guy doesn't get changed. It sits there throughout the life of the bond, but this guy, premium on bond payable, it has to be amortized to zero. Okay. And we amortize it. And why do we amortize it? Because we're taking it against interest expense, not what we pay the bondholder, that's locked in, but against what this bond actually cost us, what we call the cost of borrowing this bond. Okay. So how much interest do we have to pay the bondholder? The contract rate, how much do we have to pay? What's the math for that?
It's 8%, right?
Let's see. Yeah, 8% of what?
Is it? I don't know.
Anybody else? What? So the bond,
300,000.
Yeah, 300, Wazy also correct. So if you had that bond, you would get $24,000. No, it's actually, what is it? It's actually 300 bonds, right? Because a bond is $1,000. If you had 300 of those bonds, you would have a guaranteed annual income of $24,000. And that's not going to change for the life of the bond. So we can just copy that all the way down there. Okay. But we got to get rid of this. And we got to amortize it using the effective interest rate. We have to amortize it using the market interest rate, right? So to get that, the interest rate is 8%, but the market is 7%. So remember, our bond is the pretty bond. So that is why we sold the bond at premium, so that we can adjust to the market rate. Okay, so we're going to take 7% times what?
310, 170.
Yeah. Good, good. Okay. All right. So you can see, so this premium amortization, sorry, I've got it on the wrong column. This belongs here. And I don't want that. So what does your course pack say? What do the titles in your course pack say? Am I being consistent-ish?
Yeah, it's just my question is how come the 7% is in the premium amortization column?
Yeah, it should be over here. Let's do that. Let's move it over. Okay. How's that?
Yeah.
Okay. So what we're saying is this is the actual interest expense that the company has to recognize. This is what the company pays. That's cash. So it's telling you, this row is telling you what your journal entry is going to be right here. Okay. So you're paying cash. You're paying cash of 24,000. Okay. Interest expense, normal balance is a debit. And that's going to be the 21,000. Okay, so obviously these don't balance. We need a debit to balance this. And what is the account that we debit? Well, it's this premium on bond expense. Premium on bond payable. Okay. So whatever this difference is, 2288. Okay. Make sure my numbers are right. Yeah. Okay. You guys with me? Okay. So now we're saying we've written down this bond by 2288. We've debited the premium 2288. And now the current balance in the bond account is going to be, sorry, the current balance in the premium account is 10,000 minus 2288. So it's gone down. Okay.
Professor,
Yes.
it makes sense, obviously, looking at the table for it to be debited. I was just wondering why is the premium, like for the second table, being debited the 2288? Just
Here, right here.
Yeah, like it makes sense, like how it's laid out, like number wise, for it to like be like that. But I'm just wondering why we have it as a debit, if there is.
No, it's a good question, JR. When we issued the bond, we were able to get more money for the bond. You know, the bond face value was 300,000, but we got more money for it. We got 310. And so that effectively reduced our interest rate from 8% to 7%. Okay. But because this bond is a 4-year bond, we can't just say we got a reduction in interest rate of 10,000 the first year. We have to spread it over the life of the bond, just like as if you were depreciating an asset. Okay. So when we get that extra money, we call it premium on bonds payable. It's under the liability account, okay? But we're going to write it down over the life of the bond, and it has the effectiveness of lowering our interest rate, which it does, right? We went from 8% to 7%, and that's why we're saying we're adjusting it to the effective interest rate, the market rate of 7%. So it was a credit balance. Now, as we write it off, we're lowering it with a debit. Remember, liabilities normal balance is a credit, so to reduce them, we debit them. It's going to be different for a discount, okay? And now our new balance in not our new balance, but our new carrying value is going to be this 300,000 plus the 7782. So because they're both credits. Okay. All right. So now we say, here's our 24, but our market rate is still going to be 0.07%, but it's based on the current carrying value. Okay. So if I asked you to do a second journal entry, your second journal entry would be bond interest expense 21,552, premium on bond payable 2,448, and interest paid 24,000. Okay. I don't know if this will work. Let's see if this works. Nope, it didn't like that. Okay. So then we go to the third year and we say the same thing. We say, what's our interest expense? Our interest expense is 7% times the revised carrying value. And then we say, we're writing down this bond premium. And then let's see if we can do this. 302, 814, and we're going to do it one last time. And I'll bet you anything my answers don't come out to 0, but let's just try it anyway. Yeah, there's a little rounding there. Yeah, so see that? Can you see that, Peter, how it doesn't come out exactly to bond face value?
Yeah.
Don't worry about that. If that happens to you on the test, just leave it alone. In real life, you just change the interest expense and fix it. You'd plug that $11 and make it balance to 0, but don't worry about it for the exam. It's immaterial. Okay. All right. Okay, so JR wanted to go over page 4, which is the mortgage, JR?
Yeah, I just was wondering if we could go over quickly just the entries.
Absolutely. How
Not
far did you
necessarily.
get on it?
Oh, I finished the table, and then I think I just started overthinking it, but I didn't book anything for the 2 entries for showing the payment.
And Zachary, yeah, that's fine. And Zachary wants to go over page 10, stockholders equity parts B and D, and we can do that. Okay. All right. So here's the book value of your mortgage. It's telling you you're going to make payments of 3.7. Is that big enough for everybody? You need it bigger. I'll make it bigger. Okay. You borrowed 100 grand. You're going to make cash payments for 3 years. Okay, so this is the day you borrowed. So you're not going to do anything on this line except just record that you borrowed it. But now we're going to record cash payments of 37,411. And you're just going to record that for 3 years. And I always like to say, what was the total that you ended up paying back? Just to kind of, I don't know, it's just sort of interesting to get the bad news. So you borrowed 100,000 over 3 years, and you're paying a total of 112,000 back. So basically your cost of borrowing was 12,233. Everybody see that? Okay. So then your interest expense has an annual interest rate of 6%. So this is going to look really similar to the last problem, right? So you got interest expense of 6% times, think of the timeline. The first year you borrowed 100,000 for the whole year. So your interest expense is 6% of 100,000, $6,000. Okay. So of that 37,411, 6,000 of that was your interest expense. Okay. So the difference is what you paid your loan off. So you paid 31,411 of your loan. Okay. So what that's saying is, first year you borrowed 100 for the whole year. At the end of the year, you paid them 37,000, of which 31,411 went to pay off your loan. The rest was interest. So now you owe, if I did that right, yeah, 68,000. So now we take that same interest rate, but you haven't borrowed 100,000 for the second year. You've only borrowed 68,589. So this should feel the same as the bond problem, right? See if
Yeah.
Just do that. Okay, so we got all that. Oops, that didn't work. That should have worked.
What was the calculation to get 68,000?
So Micah, did you get the 6,000? That 6,000 is your annual interest rate times your 100,000. And then for the 31,000, that's the difference between your annual payment in December and the 6,000. And so it was saying you paid down your loan 31,411 the first year. So we subtract that from the 100,000. So I owe them 100,000 the first year, but I paid 31,000 at the end of the first year. So now I only owe them 68,000 at the end of the first year.
Okay.
So you're just,
Oh, so it's you subtract the 37
yeah,
from 100. Okay.
So the second year we say We're still making the same payment. That's, you know, think about time value of money. This is definitely an annuity problem, but we're going at it from a different angle. So we've already given you the payment amount, and it's a series of equal payments. And I'm saying, how much is interest? Interest is 6% of the declining balance. Therefore, we're still paying 37. So a bigger portion of our payment is going to pay down the principal. And now we're going to say, well, we owed 68,000, but at the end of the second year, now we're down to, we only owe 35 more thousand to pay. Okay. So the third year, so into the second year, we owe 35,000. So from January to December, we've borrowed that 35,000. So when we make our payment, we say, how much is interest? So 6% of the 35,000, which means we gave 35,293 was all principal. And at the end of the third year, we owe nothing. Okay. All right. So JR is asking, what are the journal entries for that? Okay, so complete the journal entry for borrowing the money the first year. What's the journal entry to borrow $100,000 for a company? Anybody get this one? Throw it in the chat if you did.
Is it like, so you debit cash for 100,000 and then credit note payable?
You can do that, Julie. So we often use actually a separate account for that. We often just use a mortgage payable because that's such a big amount. We want it called out.
Would you accept notes payable as well or no?
It depends how the problem's worded. If it says you signed a note, that would be one thing. If it's, in this case, it doesn't, it does use the word mortgage. So just depends how the problem is worded. You'll probably be 1 point off if you use note instead of mortgage. Okay. So then really keep an eye on your dates here. So it's saying complete the journal entry 12/31/12. And the next one is complete the journal entry for the payment on 12/31/14. Okay. So look at your schedule. They're not asking for the first payment. They're asking for the second payment. Okay. Okay. So we know the cash is going to be 37,411. So if you get stuck on these problems, do what you know. Cash goes out 37. Okay. What else can you tell me? What do you think are the other accounts?
So you debit interest expense for 4115.
And we're just lifting that off the statement. Good. And then what do we need to balance this? Well, we know what we need. How much do we need? We need this guy, but what are we calling that? What are we calling that?
Mortgage payable.
So we started out 100,000 and we're gonna charge it to mortgage payable. So that's a little different. We don't have a premium or discount with the mortgage. We just book everything to the mortgage account. Okay. So over the life of the mortgage, we're just paying down this mortgage year after year. Okay. So every year we pay a little bit more, we pay a little bit more, and then we pay it off. Okay. Until it's all gone. So the first year and then the second year until it's zero. But if you ran a subtotal each year, you'd have the balance that you owed. All right. Does that make sense, JR?
Yeah, thanks.
What part were you stuck on? Just the whole thing, or did you get part of it?
Yeah, no, the booking the first journal entry, that's what I figured it was going to be. Well, actually, I'm glad that I asked relating to the wording of the question, because I was going to say notes payable as well. But then, yeah, the second journal entry, I was a bit confused.
Cool. Okay. All right, let's look at Zach, is it this one?
Yeah, this one.
All
Please.
right. Okay. All right. So let me make it bigger. Okay, so stockholders' equity problem. And we've got empty stuff here. So the blanks are saying, I'm not giving you number of certain things that are, so this blank modifies this word, this blank modifies this word. So we're saying capital stock, $5 par value. I can read it from my copy. Capital stock, $5 par value, 360,000 shares issued. And blank, sorry, 360,000 shares authorized, blank shares issued, and blank shares outstanding. Okay. So read the questions down here. The number of common stock shares, it should say shares issued, was what? How do you calculate shares issued? Who knows?
Is it 1,550,000 divided by the par value of $5?
It is. Yay. You guys all get that? So let's say, so we're going to take 1,550,000 divided by, what's the par value? 5. And we're going to get 310 shares issued. Right. You guys with me? Now, if you come up with a goofy answer here, just as kind of a, I need you to, it's like calculating an average. If you have two numbers, one number is 100, one number is 200, and I say, give me the average number, how would you do that? How do you calculate an average of two numbers?
Add them together and divide by.
I heard part of that, Luke. Can you finish it?
You add both the numbers together and then divide by 2.
Correct. Okay. So if you have 100 and 200, divide by 2 and you get 300 just because you touched your calculator wrong. I want you to step back and say, does this make sense? And let me strongly recommend that you check all your calculator numbers at least twice just to make sure. So in this case, our number is 310,000 shares out, 310,000 shares issued. Okay. So something I'm going to ask you to do is say, when you come up with that issued share, compare it to what was authorized. Authorized needs to be the same or more than issued, but it cannot be less. If it's less, it means you just made an error with your calculator. Okay. Same for outstanding. How do we calculate the number of shares outstanding? So we now know 310 is issued, right? How do we calculate outstanding?
So you take
Minus.
the issue. Oh, okay. Go ahead.
Who was talking before Julie? Go ahead, Julie.
Okay, so you take the issue minus the treasury stock.
How many shares of treasury stock are there?
18,000.
Okay. And you're going to get what? All right, so you get 292,000. And again, I want you guys to stop and compare the outstanding shares to the issued shares. If you got outstanding shares of 320,000, something's off. It's got to be less or equal, okay? All right. So cost per share of treasury stock. How do you do that one? So we
Would
had,
you take,
go ahead, Peter. Go ahead, Peter.
yeah, I'm just trying to figure out real quick. Would you take this treasury stock and multiply it by the par?
We don't use par for treasury. So remember that journal entry. When we buy treasury stock, we debit treasury stock and credit cash. So however many shares we buy, it's whatever the market price is. And that's what goes into the treasury stock T account. So the T account for treasury stock, oops, let's see if I can do this. The T account for treasury stock has 180,000 in it. So we're going to do Merchant Center T stock, and it's a debit balance. Okay, that's the balance in treasury stock, and that represents the number of shares issued times the market price. So what was the cost per share of the treasury stock? And you can put it in the chat if you prefer. Nobody? What's the cost per share of treasury stock? Or maybe I have a lag. Oh, here it comes. Got one. Close, Katya. Check your math. Anybody else? Julie, you're correct. Anybody else? Zach, you're correct. All right. So if we have 180,000 shares of treasury stock and we purchased 18,000 shares of treasury stock, what was the cost of the treasury stock? I have two correct answers so far. So you're going to take the balance in treasury stock. Think about that journal entry. When we purchased the treasury stock, we said debit treasury stock, credit cash. JR, you're correct. 180,000. 180,000. And our description, it would have been purchased 18,000 shares. Okay, so if we purchased 18,000 shares and it cost 180,000, how much did we pay per share? And how do we get that math? What's the formula for it? JR, what'd you use for a formula?
I kind of just did like the reverse of how we pretty much figured out the
And what was your
number of shares common stock issued, but basically I just did the 180,000 divided by the number of shares, which was 18,000, to get my 10.
Absolutely correct. Okay. So just simple math, and it's going to be $10 a share. And I'm going to differentiate this because these are shares. Okay. Now, last one, what is the average? And we're going to use that same logic for D. Okay. So what's the average selling price of the common stock? Okay. So now we've got, so how do we figure out the average selling price of common stock? Can't spell today. So we have to look at two accounts. We have to look at Oh, hello. We have to look at APIC for common stock, common stick. I can tell it's Friday. All right. Oh, that even looks better. Never mind. Okay. So we have to look at the balance in common stock. What is the balance in common stock for this problem? Right. What's the balance in common stock? Go ahead and put it in the chat. And you have, in this case, Zachary, you're correct. So Julie, yes, the balance is what's right here, 1550. So it's going to be. And what's the balance in APIC? What's the balance in APIC? 165, 165. Yes, yes, yes. And it's a credit balance because that's the normal balance for this. Okay. Now you could have also taken the 1715, but you have to be mindful that that would also include preferred stock if there were any. So you really want to make sure you're only using the common stock accounts and the additional paid in capital for common stock. Okay. So you take those two together, add them together, and you get the 1715. So we're going to do equals, no, let's do it like this. And that's going to be equal to 1715, I think. Yeah. And then we're going to say now we know that total and the average issue price. What do we divide by to get average issue price? What number do we divide by? Julie, you're correct. Anybody else? Zach, no. And this is tricky. This is tricky. Katya, yes. Okay. So what goes in to common stock is the issued shares. So even though we issued 310, even though there's only 292 outstanding, that's only calculated after you subtract the issued shares minus the treasury shares. So when I ask you what was the average selling price of the stock, we're going back to the issued shares. So we're going to take this 310 and we're going to say, what was the average issue price of the common stock? And it's going to be, let's make it a $5.53. Okay, you guys see that? Because the balance in common stock isn't the number of shares outstanding, it's the number of shares issued. So in the treasury stock, that's where you have the 18,000. That makes sense? Okay. All right. Okay, so you have other problems here. I'm going to take a look at your, this is a similar problem, but the bond carrying value in the second, we're on page, let's take a quick look. I know we're over time. I'm just going to tell you real quickly. On the second page of your course pack, of your practice exam, you have a similar problem on page 3, but this time you have a bond discount. Okay, bond discount. And so here you have a face value of 4 million, but you only collected 3,700,000 because you have a market rate of 12%, but the bond's only paying 10%. Okay. Mortgage, we talked about. Appendix G, we've got some problems. More Appendix G, calculating the selling price of a bond. We've got a payroll problem, bunch of current liability problems, interest expense, sales tax, magazine subscriptions, which is going to be unearned revenue. And then how do you calculate, if you get the total amount for sales and it includes sales tax, how do you calculate the pieces? Okay. And then we just have that, which we just did. And then a couple of journal entries for issuing stock. All right. All right. Any other questions I can answer before we say goodbye?
I have a question.
Yes.
Are we gonna have an essay question again?
Let me, am I sharing my screen? Tell me no.
Not anymore.
Okay, let me check. I don't think so. I wrote the test a week ago.
I didn't find one in the practice, but just
No. I can't say that there's an essay question. There are some short answer questions on theory and definitions about stock and a few on the liabilities. So, you know, we went over definitions on different types of bonds, what's a mortgage, anything that's on the PowerPoint, you know, what is it? What are pros and cons, advantages, disadvantages of a corporation, all of that. Let me, and I believe that's on, I'm just going to check here. Yeah, if you look at the practice exam on page 1, I believe it's, so understand the theory of corporations and stock, understand the theory of liabilities, notes payable, that kind of thing.
Okay.
All right. And can you cross this last one off? You do not need to estimate warranties. So we didn't cover it in this book. So. All right, you're welcome, JR. Have a good weekend, everybody. And,
Thank you.
remember, no school on Monday. So if you have questions, you can email me. I won't be having office hours. So.
Thank you.
Okay, thank you.
All right, you guys
I
take
do
care.
have-
Oh, go ahead.
I do have one question. I
Go
was just gonna
ahead.
ask when you plan on posting the answers to the practice exam?
I'm going to take a look. You guys had to post your answers by last night. Am I correct?
Uh-huh. Yes.
Okay, so if you've all posted, I will release them. So
Okay,
I'll
cool.
just
Thank you.
I'll take a quick look after class, Micah, and then I'll release them. They're on a time release, but if you've already posted all your answers, if you've covered them, I'll go ahead and post them. If you still haven't covered them, I'll send you a message saying, can you do these, make sure to finish the problems. So
Oh, for like the whole class, you're saying?
yeah, because I've got 24 students who have posted, and that was due last night at midnight. So
Okay,
I'll just check and see if you guys, sometimes you guys just keep answering the same questions. So
right.
I'd like you to try and make some attempt to answer, not you personally, but overall as a class to answer more questions. So
Yeah, I think whenever the discussion board opens up, we can't see like who posts which questions. So a lot of people pick the easy questions. Which is, you
that's
know, makes
completely
sense.
understandable. So I should change that and make it so you can see everybody's questions first and then take it from there.
Okay, well, thank you for
All right,
the
Mike, if you have any
class.
questions, if you want to meet, if anybody wants to meet on Tuesday or just send emails on Tuesday, I'll be online all day. So you can send me a message and I'll try to get back to you right away. So,
Okay.
all right. Okay, you guys
Sounds good.
take care. Ridwan, are you going to stick around for a minute?